Hello. If you've been following the financial markets, you've probably not been able to go more than a couple of days without seeing something about a new SPAC being raised or companies going public via a SPAC. SPAC is the new hot thing in the market, and people seem to be getting on this new ride. Just to share some perspective on the scale of SPACs and the hype surrounding it, DraftKings, an online fantasy sports and betting platform, currently has a market cap of over $21 billion and is up over 400% since the initial IPO. Nikola, the electric truck startup, hit an all-time high of 500% returns within 2 months of its recent IPO. Virgin Galactic, Richard Branson's commercial spaceflight company, has a market cap of $8 billion and is up over 200% since its IPO. In addition, Bill Ackman, the founder of Pershing Square, raised a $4 billion fund with the intent to take a mature unicorn public. So what's common among all these blockbuster rapid IPO gains? These companies were quickly taken public and listed on the market via a special purpose acquisition company framework, popularly known as a SPAC. Interestingly, those launching SPACs aren't just former CEOs or private equity investors anymore. Celebrities like Colin Kaepernick, Shaq, Tony Hawk, and Jay-Z have gotten in on the action. Buying into the hot market excitement, everyday investors are in on the new trend as well. So much so that the US Securities and Exchange Commission has even taken notice of this trend and opened an inquiry into the SPAC frenzy. In 2020, SPACs raised much more cash as they did over the entire preceding decade. And already by May this year, there were more than 300 listed SPACs, generating gross proceeds of more than $100 billion US. To put this into perspective, this figure to date has already surpassed the total proceeds from SPAC in 2020 alone. There seems to be no stopping to this bull run. So what is all this about? In this video, I will walk you through what SPACs are, how they operate, what's running the current hype, and my outlook for SPACs. So to start off with, what is a SPAC? SPAC stands for Special Purpose Acquisition Company. It is essentially a blank check company that goes public and raises money with the specific intent of using the proceeds to acquire a private company which would be identified after the SPAC goes public. Everyday investors can put money into SPACs. They're traded on various exchanges, most primarily in the US market currently. And before the SPAC has bought a company, its funds are typically invested in a government bond or a trust. For example, SPAC, essentially a shell company in its early days, could raise X million dollars from the public through an IPO listing, purely based on the trust factor in the SPAC founder's ability to find a good startup or investment, and then about 6 months to 24 months later, acquire a private tech unicorn. The unicorn then has an incremental X million dollar valuation, is also a public company, without having to go through the tedious regulatory oversight and audits associated with traditional IPOs. In a sense, SPACs are transforming how companies can raise money and go public. So what constitutes a SPAC? From an entity perspective, SPAC is primarily composed of the owners or the lead sponsors of the SPAC. Often, the SPAC is associated with a venture fund, celebrity investor, or other institutional investors. The owners of the SPAC or the sponsors are responsible to put up an initial percentage of the capital to cover investment banking, regulatory costs, audit costs, and any other investments required to cover the initial IPO. The owners or the sponsors of the SPAC, through their expertise and network, also put their vote of confidence behind the target company, which will then be acquired. Second are the operators of the SPAC. As a public shell company, the SPAC has governance requirement which is typically fulfilled by a CEO and a board of directors. The task of the CEO is very limited initially. It's all about trying to find a company, negotiating the term deals, and then acquiring it. In other cases, the SPAC directors are also window dressing to legitimize the SPAC and make it easier to raise money or acquire targets. The owners of the SPAC, that is the sponsors, and the operators, which is the CEO and the board of directors, often overlap quite substantially in most cases. Third, and most importantly, are the investors in the SPAC. Often public market investors, the SPAC investors have some say in who the SPAC merges with. In particular, the investor can choose to redeem their capital if they do not approve a merger. This means the SPAC owners need to get a buy-in from the SPAC investors to actually acquire a target company. This means that SPACs end up with a three-way negotiation on the valuation, the governance and negotiation, and various other items between the various stakeholders. So what's new about SPACs and why are we hearing so much about it now? SPACs have been around for decades and often existed as a last resort for small companies that would have otherwise had trouble raising money on the open market through traditional IPOs. But they've recently become more prevalent because of the extreme market volatility in the current pandemic situation. When the pandemic struck last year, investors across all industries and geographies worried about their market portfolio volatility. Most portfolio managers and hedge fund managers held their current investment plans and reshaped them to become more conservative. Similarly, companies that were planning to go public via IPO postponed their plans. No one wants to go public and then watch their stock tank because of a global crisis and lack of uptake by retail investors. Now that markets are stabilizing and the worst of the crisis is behind us, these companies want to get back on track with their plans to raise investments. And instead of restarting the IPO process, which is typically quite tedious and long, they're looking for SPACs, which are a quick, cash-rich way to acquire and raise company so that companies can go live immediately and scale. Moving on, let's understand the typical SPAC timeline and the process. Let's start with the basics. A group, known as sponsors, the founders or investors, who are typically front-ended by celebrities, as we just saw, go to the market and say, hey, we're really good at buying companies. Give us some cash and we'll find you a killer deal. If investors see value into this promise made by the sponsors, the investors buy into the IPO and will be given stock units in the SPAC. Here, retail investors, just like you and me, essentially invest in a shell company and hand over a blank check to the sponsors with the hope that they'll find this killer deal that they've promised us. Units, or the stocks, are generally priced at about $10 per unit, and each unit generally consists of one normal share of stock and one warrant, which is exercisable at about $11.50 per share. The SPAC then takes all of this money it has raised in the IPO and puts it into a trust account. Post the IPO, the SPAC typically has a fixed period, around 24 months, to complete a business combination with a target company. Expenses for this process are typically funded by the sponsors themselves, although interest from the trust account may also be used. The sponsors then go and start looking for a company to buy. Once they find one and negotiate a fairly attractive deal, the sponsors go to the investors and say, hey, here's the exciting deal that we promised you. It's going to be raining money soon. Vote for it. So the SPAC shareholders, that is you and I, can then vote to approve the deal or redeem the stock and get the cash back, plus whatever little interest that it may have earned in the meanwhile while sitting in a trust account. If enough unit holders vote for the deal goes through, and then there is a process known as a de-SPAC transaction where the name changes to whatever company was acquired, and the company which has effectively completed an IPO, it becomes a normal traded, publicly traded company. If a business combination fails to happen in the specified period, The money from the trust account is returned to the investors. That's simple enough, right? So let's dive a little further to study the key economics of a SPAC and how sponsors are significantly incentivized in this model. Firstly, the at-risk capital. SPAC owners put up the at-risk capital of the SPAC and in exchange reap an economic bounty if the SPAC works. So while each SPAC is unique, the terms of the SPAC roughly include an initial upfront investment of the order of about $5 to $10 million, which is minimum to require the expected expenses and the investment banking fee to take the SPAC public. They perform the search, they pay the operators, the directors, and if the SPAC never buys a target within the time frame, the money is lost, and hence the name at-risk capital. Secondly, the upside. In return for the at-risk capital, SPAC sponsors have a lot to gain. SPAC owners typically receive about 20% of the company equity of the entire SPAC. For example, if you raise a $500 million investment, you may receive $100 million of the value when the SPAC buys the target company. In a few cases, to attract the retail investors and establish what's called a skin in the game, the hurdles are interested. Let me explain this. For example, a sponsor may receive the 20% promised equity value over a period of time only if they achieve a minimum X% annual internal rate of return for the retail investors post the IPO. Thirdly, the warrants. In addition to the SPAC upside, SPAC owners traditionally have negotiated additional warranty coverage with the target company that they've acquired. In fact, early SPACs had as high as a 1:1 warrant coverage. That is, they could buy one share at an extremely steep discount for every share that the SPAC bought in the private company. Going further, let's try and evaluate how this entire ecosystem of stakeholders stand to gain via the SPAC framework. Firstly, the target businesses. For a company, the SPAC provides a means of going public in any environment and get access to public markets, which is otherwise a very difficult thing to do. Compared to a traditional IPO, going public via a SPAC is a lot quicker and cheaper with fewer regulatory hurdles, and also involves a valuation certainty in the sense that the initial valuation is set based on the negotiation with sponsors rather than based on the investor demand. Compared to exiting via a sale, SPACs allow the company management to retain some stock in the business and also have an upside participation once the share value increases. For sponsors, as explained earlier, SPACs is an effective way to leverage the trust factor that they have and tap into the public markets to raise large sums of money towards investments that are even yet to be discovered. The economics of the transaction tend to be most lucrative for the sponsors, given the 20% equity they receive in lieu of the initial at-risk capital that they put up. From an investor perspective, SPACs allow retail investors to get in relatively early into a potentially attractive investment opportunity alongside very successful investors. In addition, this investment is liquid from very early on, and in case of a failed transaction, the downside is protected since the funds are held in a trust account. The downside protection, which is only in case a deal isn't found, is the liquidity that the SPACs allow for that make it extremely attractive for investors to access potentially high-yielding investments. So far, we've seen how SPACs can be highly lucrative, but at the same time, it is equally important to note that SPACs are fraught with all kinds of risks. Most primarily, they are highly speculative. Investors are completely betting on the sponsor or the celebrity and not on a company. This adds a significant layer of uncertainty to any investor who's getting into a SPAC. Next, given the low regulatory requirements, SPACs can tend to overinflate numbers to attract investments. Interestingly, from what I read, it took Google over 8 years to reach $10 billion in revenue, which was the fastest ever for a US startup. 5 companies with current SPAC combinations in the EV, the electric vehicle space, currently project reaching about $10 million in revenue in just 3 to 5 years. Perhaps there is a reason that such statements are not allowed in traditional IPOs. Thirdly, it's the time constraint. The limited time frame of about 18 to 24 months that SPACs have to complete a negotiation and acquire a company is a major factor that may influence the quality of company that a SPAC acquires. Under such rough time constraints, sponsors may often rush to find suboptimally viable companies to acquire. Lastly, the returns in this whole model are skewed in favor of the sponsors, who typically pay nominal amounts for as much as 20% of the SPAC shares before the acquisition even happens. Also, as SPACs continue to gain rapid popularity, there may be more funds than viable companies to acquire that could potentially lead to a SPAC crash. So moving on, let's come a little closer home to understand what the picture is in India. SPACs haven't picked up in India primarily because of the regulatory restrictions. The Companies Act 2013 is perhaps the biggest roadblock for SPACs in India. De-SPAC transactions stand in direct contravention of the Act, as well as various other Indian laws, such as the SEBI regulations, the FEMA, the RBI Master Directions, as well as the Income Tax Act of 1961. Thus, this act would require significant amendments for SPACs to establish a certain structure in India and meet their objectives. Further, the SPAC framework is also in direct non-compliance with the SEBI norms, which has laid down eligibility criteria for an IPO. The law states that an IPO requires companies to have net tangible assets of at least 3 crores INR in the preceding 3 years, a minimum average consolidated pre-tax operating profit of 15 crores INR during any 3 of the last 5 years, and net worth of at least 1 crore INR in each of the preceding 3 years. Any alternate routes circumventing this will prevent investment opportunities for retail investors who can't be allotted more than 10% of the IPO listing. Also, if you look at it, SPACs don't sit really well with the current context of the Indian government's view of shell companies. The central government's endeavor over the last few years to check the rise of shell companies has direct consequences to how SPACs would be perceived in India. Indian regulators have every reason to be wary of shell companies on account of their previous involvement in tax evasion cases, as well as other economic offenses that have been committed. Like the phrase shell companies, the term SPAC is also not defined anywhere in Indian law. However, since SPACs are shell companies in terms of their operational entity and mechanism, they're likely to be engulfed by the prohibitions imposed on shell companies in general in India. For SPACs to pick up in our country, there is an imperative to place a comprehensive regulatory framework and governance mechanism by which RBI and SEBI can define and establish a legally backed structure for SPACs in India and eliminate any existing restrictions. It'll be a revolutionary milestone in the capital markets industry, and especially for the booming Indian startup ecosystem in general. Luckily, that's exactly what's happening. About 2 to 3 days back, SEBI announced their plans to build a dedicated framework for SPACs to be operational in India. It'll be interesting to see how some of this will evolve in the coming days. Clearly, SPACs have witnessed a lot of action in 2020 and 2021. And before we blindly bind to the frenzy, it's important to cut the clutter and look beyond the noise. So that brings us to the new section on moving beyond the hype and mapping actual performance. As per a study by the Wall Street Journal, SPACs which went public in the year 2015, 2016 are now trading way below their IPO share price, leaving most of the investors wary of their investments. On average, SPAC structures have led to a 12% decrease in value of the merged entities after 6 months, and as much as 35% decrease after 1 year, according to another research report. The most recent batch of SPACs is actually not faring any better. Despite all the media attention that it's been receiving, by mid March, the blank check vehicles that IPO'd in 2021 were trading at or below their IPO price. So it is really a tough bet with SPACs. So that brings us to the next question. What's the outlook for SPACs? So I will break this down into two components, a short-term view and a long-term view. From a short-term perspective, what can we expect in 2021? Firstly, there will be stiff competition amongst the SPACs looking to acquire target companies before their 24-month timeframe elapses. This stiff competition could lead to friendlier terms to woo target companies for acquiring. Also, as competition becomes stiff, some of the SPAC sponsors may onboard a lot more celebrities or far more star CEOs to create a differentiating factor for their funds. Most importantly, attention around SPACs could shift to the European and Asian markets, where the regulators are either evaluating or are already working to change rules to allow for SPACs to be operational in their countries. Next, let's look at the long-term perspective. Macy, professor at Yale University, compared investing in a traditional IPO with making a bet on the direction of a ship that has yet to leave the dock. However, with a SPAC, Macy said, it's like you have a captain, and this captain is telling you that he will eventually buy a ship and then figure out where it will go. So clearly, there is a lot of uncertainty and risk factor associated with SPACs. With that established, I believe retail investors need to be very discreet when subscribing to SPAC IPOs. The long-term success will require strong regulatory frameworks and clear expectations by governments around the disclosures that sponsors need to make around at least the direction in which their investment plans would work at the time of launching the SPACs. There are certainly pros and cons to this model, and I do believe the current frenzy and hope will die down as companies become more deliberate around the real value of traditional IPO versus a SPAC model. With that, I hope you found this video interesting and useful. I would be very happy to connect with all of you on LinkedIn to hear your thoughts on the subject and discuss further. Thanks again, and goodbye until next time.